Our next question comes from Justin P. Justin says, I'm trying to determine if I should pay off my rental property, which is a duplex, as fast as possible, or if I should put all of that money into the market instead. My interest rate is 5%, and I'll be keeping the rental property once it's paid off to earn rental income as extra cash flow. Really good question, Justin. Robert and I are always saying a phrase that is, make sure your money is working as hard for you as you work to earn it. And when we say that phrase, we mean make sure that your money is earning as much possible money for you, because we all work really hard to take money home every single paycheck. And when we say that, we really encourage people to apply that as a, don't let it just sit in a checking account. If it's going to be sitting in a savings account, make sure it's a high yield savings account. Don't pay off low interest debt with your money. If you can go invest it somewhere else to make more money with your money than just saving on that 3, 4, 5% interest rate. So that's, generally speaking, what we mean when we say that phrase. I would argue that phrase right now, Justin, would apply to you. You have a 5% interest rate on a duplex. And assuming the duplex is already cash flowing and it's already appreciating and doing all the normal fun stuff that rental real estate's supposed to do over a long period of time, taking money essentially out of the markets, which is what you're doing in this situation, to then pay off a duplex to save 5% interest maybe isn't the best move. I would argue that you could earn 7, 10, 12% in the markets on an annualized basis over a long period of time, which is 5, 7% more than what you would save in simple interest on this mortgage. So my perspective is compounding in the markets, likely over a long period of time, is going to be a better move than taking all of this money to pay off a duplex. But you really just have to run the numbers, make sure it's cash flowing, make sure it's appreciating, all that fun stuff.
I agree with Austin 100%, Justin. With a 5% interest rate on your mortgage, I wouldn't pay a single penny extra in payments. Here's a quick illustration. The S&P 500, you hear us talk about VOO all the time, has returned over 90% in the last 5 years. QQQ, over 90% in the last 5 years. Bitcoin, over 900% over the last 5 years. So we always talk about this, making your money work as hard for you as you work to get it, but it also comes down to having the positive arbitrage be in your favor. And right now, if you're paying a 5% interest on your mortgage and you can make 10, 20% in the markets and sometimes higher with the Bitcoins of the world, why would you not want all that extra money going in your pocket versus paying down what is presumably a pretty low interest rate mortgage? That's my opinion. I always want my money working as hard as possible, never letting it sit. And you're in a great situation with this 5% interest. I would not pay extra payments.
I really think the best way to think about this, Robert, is let's say it's a $300,000 account and the $300,000 is invested correctly across the index funds and ETFs we talk about. It's got some diversification. It's got some, high growth names in there. It's also got some cryptocurrency and whatever else you have in your $300,000 account. I would argue that $300,000 account year to date would be up 6, 7, 8, 9% right now. Maybe it continues to go up even more beyond that. Would you sell all stocks in that $300,000 account to take $300,000 in cash to pay off this mortgage at 5%, to lock in a guaranteed 5% per year for the rest of the time you own this mortgage? That's the question you're asking yourself. And the reason why, again, I don't think I would do it is because compound interest is much more important than simple interest. So on a mortgage of $300,000, a 5% interest rate is about $15,000 a year in interest. Well, let's now go forward 1 year. Let's say, of your mortgage payments, it brought down your principal that you owe now to $295,000. You now owe 5% interest on $295,000, which is $14,750. So the amount of money of interest that you owe is going to go down every single year until you pay off this specific property. The flip side is happening when it's invested, right? So let's say I earn 10% in the markets on this $300,000. That is $30,000. Now you're going to earn 10% on the $330,000 invested, and then another 10% on the $363,000 invested, right? So your money grows exponentially while your interest just goes down like a solid, line. So it's just understanding compounding versus simple is like just it's such a life hack. It's crazy.
It is one of the biggest life hacks, and I just love getting to dig into these questions and really answer and help people understand, because so many people are trained to pay off debt as quick as possible, and it's just not good advice with low interest debt, which I believe 5% is in that range of low interest debt, especially because for the past 3 years, the markets have been ripping with much higher returns. And that's why I just like to, when in doubt, zoom out and look at it long term.